The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everyone, to Meet Community Bank Asset Liability Regulatory Requirements, Calculate Interest Rate Risk Sensitivities, and Document Your Compliance Automatically. This is a special webinar we're offering today. My name is Howard Lothrop, and I'll be your host. While on this webinar today, everyone will be muted, so please submit any questions through the question box. I can't promise we will get to them all, but we'll try. A quick disclaimer: we use data we believe to be reliable, but we do not warrant its completeness or accuracy. We are not providing accounting, regulatory, or legal services, and you must determine if this information is suitable for your specific needs. Again, my name is Howard Lothrop. I'm a community bank consultant at Echo Partners. I have over 30 years financial risk management experience, including 15 years as senior vice president at a large regional bank. And for the past 8 years, I've been a community bank consultant. BankRatingReports.com is a standalone bank rating reports service, and Community Bank Networker is an umbrella organization concerning community bank information. So with all of our introductions complete, let's move on into regulatory requirements. You must know and be familiar with your regulatory requirements. Otherwise, it's like playing a game without knowing the rules. And we know how that's likely to turn out. Even if fortune smiles upon you, you'll do less well than you could have. So with that in mind, let's start at the beginning. OCC Bulletin 2016. This is the great granddaddy of them all as far as interest rate risk and model validation is concerned. It clarified several key concepts, including the fact that you must validate your model inputs, that is, the information you put into the model, your financial results. You must validate the model processing. This is where we must examine and validate the arithmetic accuracy of the model. And then finally, validating your outputs and making sure that your results match up with reality. You know, these key concepts are still equally valid today. In 2010, a joint regulatory advisory on interest rate risk was issued. Here we have a copy of the FDIC's version, the Financial Institution Letter FIL 2-2010. Several key concepts introduced in this Financial Institution Letter include the need for a full 400 basis point rate shock, an annual review of your interest rate risk model and your interest rate risk management process, and vendor validation of any models that you obtain from a vendor. The environment with continued low interest rates caused the regulatory community to come up with these additional clarifications and extended requirements for interest rate risk. Finally, we have the OCC Bulletin 2011-12, Supervisory Guidance on Model Risk Management. Now, this supersedes but really reiterates and reinforces the key concepts of OCC 2016. If you know these three key regulatory releases and the information contained within, you're well on your way to a successful interest rate risk management exam. And so from there, let's go on to talk about calculating our interest rate risk sensitivities. I mean, that's really what it's all about, quantifying your interest rate risk. And there are three main ways to do that. We're going to start, first of all, with looking at GAAP. GAAP measures the difference between how many assets are scheduled to mature or otherwise reprice in a given period relative to the liabilities. If more assets reprice, then you're said to be asset sensitive. If more liabilities reprice, you're liability sensitive. Asset sensitive banks, generally speaking, will do well in rising rate environments, while liability sensitive banks will do well in falling rate environments. Now, what we do to create a gap report is we list out all of the line items on the balance sheet, take note of whether or not they are amortizing or are of a bullet maturity, separate them into time buckets, and adjust them for likely prepayments. It's really quite a straightforward process, and it gives you, even today, especially for a bank with a less complex balance sheet, a very good insight into your basic interest rate risk. An added benefit of the gap report, of course, is that most people in the bank understand it. From there we go to the earnings at risk calculation. Earnings at risk is a more sophisticated simulation approach. It tends to be more accurate with respect to things like optionality, prepayments, and those sorts of things where we have cash flows that vary relative to interest rates. It is an easy to look at, familiar bar chart here. You see the bar chart on the right rising, showing your net interest income increasing as rates increase. This bank would be said to be asset sensitive. Now here's the key thing about this report. It generally is shown over a 12-month period of time. You must, however, have additional earnings at risk time periods, 24-month, 36-month, 60-month, in order to fully get the benefit out of this report. Secondly, there's a wealth of good management information here. Most bank managers want to know about earnings. They're fixated on earnings. So it's a good place to start to look for strategies to implement at the bank and to avoid any roadblocks along the way. From there, we'll turn to the third and final major way to calculate interest rate risk, the economic value of equity. Now, unlike the first two, gap and earnings at risk, economic value of equity is a measure of the long-term interest rate risk at the bank. So instead of looking at a particular time period, say 12 months or 24 months, the economic value of equity is calculated over a sufficiently long period of time so that all of the bank's assets and liabilities are able to fully reprice. The way this is calculated is that your book values are adjusted to base. That is, we'll take things like your securities portfolio and adjust them to fair market value. Then we'll look at how they vary with changes in interest rates, present value these numbers, and look at the residual difference, and that is the economic value of equity. It's, again, a lot of good information. Bankers could potentially spend some more time getting to know this report. Now, if we want to look at these for analysis purposes, it's often best to look at them over the full range of interest rates. Here we're looking at the change in cumulative gap. It shows a different color line for each rate shock environment, up or down 1, 2, 3, or 400 basis points. Here's the key on this cumulative gap snapshot. Where the lines are tightest together has the least interest rate risk. And those places where there's the greatest variability or distance between the lines, such as in the 1 to 2 year or 2 to 3 year time buckets, are the areas where the bank has the most interest rate risk. Again, the earnings at risk snapshot shows us the same thing. It's the up and down 1, 2, 3, 400 basis point change expected for an instantaneous static rate shock. Here we see a very modestly asset-sensitive bank. Interest rate, net interest income rather, is projected to increase just a small 5% or less over the full 400 basis point range. This bank is very stable in the short run. Economic value of equity, again, remember, this is the long-term measure of interest rate risk where every asset fully reprices, shows a slightly different story. It shows a bank with a limited liability sensitive position. That is, as interest rates increase over the very long term, this bank, as is, in a static sense, with no management or asset or liability mix changes, no balance sheet mix changes, would tend to have net interest income and therefore economic equity fall in the very long run. Now, many times because of the long-term nature of EVE, these numbers become outsized percentages. These are very small and stable measures of EVE shown here. Bankers tend to get a little excited when they see the big interest rate risk numbers associated with EVE. Keep in mind that this is a double-edged sword. Yes, because it is a long-term, highly leveraged way of looking at your risk, it tends to magnify the risk, but it also means that if you actually implement some form of management strategy change or a change in your balance sheet mix, it really is the easiest risk to adjust. So now that we've looked at the three main methods of calculating your interest rate risk sensitivities, let's talk about documenting your compliance. And there are several things you want to look at here. The first thing we're going to look at assumptions. Assumptions are the special, unique, individualistic changes that make a generic model fit your bank. Here you can see we have changes in prepay speeds over various rate change scenarios for all of the time buckets for all of the various line item assets and liabilities. Then you can see at the bottom of the page we allow you also to specify changes in decay rate or average life for your non-maturity deposit accounts, such as your transaction accounts, your money market or savings. This is what differentiates your bank from any other bank running the same model, the specific assumptions that you use. Assumptions are going to be one of those areas that an examiner is going to look at, and if you have a log of your assumptions showing and detailing who examined the assumptions, why they either changed them or left them alone, and can replicate this, then that's really a step in the right direction for your interest rate risk exam. The next thing we're going to look at is a backtest. And here you see an annual backtest. We'll jump ahead one more page and look at the quarterly backtest. A backtest is one of the ways that we're going to validate the model outputs. Here's what we do. In the upper left-hand corner, you see that we had a forecast. The forecast is what the model said 3 months ago it expected your results to be. But there were three things we didn't know 3 months ago. We didn't know how much the bank would grow or shrink, that is the volume. We didn't know how the bank's asset and liability mix, your balance sheet mix, would change, so that's the mix column. And we didn't know exactly what the interest rate risk position was going to be, how were interest rates actually going to change in the period. So if we take adjustments for these three unknown variances, for volume, mix, and rate, we'll end up with the lower left-hand corner, which is the adjusted forecast. The adjusted forecast represents the forecast the model would have made had it been possible to know with certainty the outcome of the bank's growth, balance sheet mix, and the interest rate risk environment. We then compare the adjusted forecast with your actual net interest income line items and look at the dollar and the percentage variance. Now here you can see on a total interest income basis, we're within 1 3/4%. Total interest expense right at 0.75%. And net interest income or expense less than 2%. These are very good numbers, very tight fit. Generally speaking, if you can demonstrate results less than 10%, these are considered good results. Now here's the key for a backtest. If you did not have this sort of a good fit, that's the signal that says maybe you should consider adjusting some of your assumptions. Adjust assumptions if you have results that do not provide a good backtest fit. Finally, let's take a look at the format of a third-party independent model validation opinion. What we do is every year we go out, we contract another consultant, an interest rate risk consultant, to perform an independent validation of the model that we use. It covers such things as data integrity, calculation accuracy, reporting, and it's timely and it's updated, and it's the biggest, most common shortcoming that I find when I examine banks' interest rate risk management setup is they do not have a timely and updated independent model validation opinion in their files. Now, I know we've covered quite a bit of information very quickly. If you want to get more information, contact me at echopartners.com. That's ECHOpartners.com. We'll be glad to give you a sample asset liability report at no charge, complimentary for your bank, and also be glad to answer any asset liability questions that you might have. Once again, this is Howard Blothrop. Thank you very much for attending. We look forward to seeing you on our next webinar. Thank you and goodbye.